Welcome back, you legends. I'm Dr. Can. Let's get right into this quick market update video. Happy Labor Day. Happy Labor Day. I hope you all had a great weekend. So let's get right into it. Last Friday we had a market recovery. All the indices, the Dow, the NASDAQ, the S&P, and the Russell rallied higher. If we take a look at the stock market map, we see green all across the board, but specifically in consumer cyclicals. That means Friday was a risk on day, which if we take a look at the different market sectors, we can clearly see that cyclicals, technology, industrials, financials leading. That means risk taking is back on the table. The defensive rotation is now off, and now we're getting that offensive rotation back as market hopes renew that we trade into new market highs for the S&P 500. At least if we take a look at the daily chart for the S&P 500, we had this pullback. The market topped on August the 26th in this complex topping structure. This looked like a bearish rising wedge. Once it broke down, we had the market top. That market top gave us a measly, tiny little pullback in the S&P. In the NASDAQ, it was a more substantial pullback, I would say. And Friday was that buying opportunity after we developed this bullish hammer candle for the NASDAQ, and we saw the rotation back into offensive sectors, risk taking back on the table, technology, cyclicals leading again. That is something we actually expected and that I talked about in detail in my last video. The market was trading in this range, and we discussed in detail how the market tends to trade outside of these ranges. And nearly all the time, we tend to get slightly higher lows, and then we get a consolidation near the top of the range, and then we get the breakout, flush out all of these shorts that have their stop losses here at this top, at the top of the range, flush all of these bears out, get the breakout, and then give us that rally and final top in that final seasonal top that sets us up for usually a negative September and October. This is the S&P 500 seasonality for election years. This is the average of all election years, and this is the open field kind of election year seasonality. Open fields like this year tend to be more negative, more bearish. We tend to get a very negative September, very negative October. Then we get a bit of a rally between the end of October, early November. Then we get the final dip in late November, and then we get a rally, but we never reclaim these prior highs. In an open field election, in a run-of-the-mill kind of election seasonality, we tend to get a bottom at the end of October. Then we tend to get a very strong November, very strong December, that holiday rally, and then we tend to make a higher high. That means we make new highs. For this year, I'm kind of in the middle. I'm not sure if we're going to get something that looks like this or this. Either way, I plan to trade this seasonality with a market top developing in early September. That means likely this week, next week, we should get a market top. Bearing that in mind, we do have a rate cut scheduled for the middle of September. That means we can continue to get pullbacks and rallies and then top in the middle of September after the rate cut, kind of sell the news event after that Fed meeting, and then we get that correction into the end of October, that seasonal correction. I tend to believe we'll likely see something more like this. So rally into the Fed rate cut and then get that correction, that sell the news event on the rate cut, and then we get that sell-off, that seasonal sell-off, and then we get a bottom at the end of October and a rally. So let's take a look at the S&P 500 and NASDAQ 100 1-hour charts. I discussed this in detail in my last video. I said to look for this. See it, successive higher lows. That's positive. We've seen that happen out of significant market consolidation structures, and that tends to mean that the NASDAQ will rally at least back to these prior highs and more likely than not actually exceed these prior highs. For the S&P 500, look for a consolidation at the top of the range, and then for a breakout that exceeds all the prior highs where the market likely makes a new high. We need to see the S&P make a new high, and then we need to see the NASDAQ 100 fail to exceed the prior highs in July. That would signal a more significant market topping structure, and I think that would be synonymous with that topping process that should come in as the market begins that seasonal correction later in September and throughout October. So if we take a look at the S&P 500 kind of consolidation slash pullback pattern, looks a lot like this kind of consolidation slash pullback pattern. Market tops, pulls back, moves sideways for quite a while, then puts in this inverse hammer candle, then puts it in a bullish hammer, and then we get the breakout. If we take a look at what happened recently, market tops, pulls back, puts in a couple of indecision hammer candles, and then we get the breakout on Friday. If I take a look at the S&P 500 1-hour chart, I discussed this in detail, but I need to mention this again. If we take a look at the market structure back in the May top, we had an established range. Then we had the market rally break above the range. Usually when we open above the range after significant multiple tops like this, we tend to establish a bearish divergence. That is, market makes a higher high, RSI fails to make a higher high, then we get that sell signal. In this case, it was this bearish engulfing candle right here. That was the sign to get the hell out of the market. And then we had that common retracement back, the 62% fib retracement level. Market fails to clear this level, and then we get the breakdown and the end of the pullback. If we go further back, the market actually now very likely is establishing a range that looks more like this, the range that formed back in the middle of March. You see multiple tops here. These are stop losses by short sellers, by bears. Once they get the breakout above these short seller stop losses, we tend to get a squeeze and a rally, and then we tend to get kind of another range pattern. In this case, this was the final range, and once we got the bearish engulfing candle, it confirmed lower low, told us that the market actually topped, and after that, we got this perfect retracement back, the 62% retracement level, exactly like what happened in that other range that I discussed just in a minute. And then that was the final shorting or exiting opportunity. And then we had a prolonged kind of correction, significant correction that bottomed in late April, I believe, yes, 19th of April. So what's happening now is we're in this kind of stage. This was Friday. Now look for a consolidation at the top of the range, right? Look for a consolidation at the top of the range, and then potentially a breakout later and a market top potentially either this week or later next week before the Fed meeting and that final topping process on the Fed meeting. Now, next week, we do actually have a lot of key events coming up. We do have Friday unemployment data in non-farm payrolls. Remember, the last unemployment data in non-farm payrolls led us to this kind of massive sell-off. It happened right here. It was very close to that capitulation bottom. We had very bad unemployment data, significantly higher than expected, 4.3%, and it triggered the Psalm rule that indicated that the market is now entering a recession. Not the market, excuse me, I should say the economy is entering a recession. Psalm rule was triggered. That told us economy is now tipping into a recession. If you want to know how to trade the final market top, that recession kind of top and crash, check out this video published about a week ago. Nvidia earnings aftermath, S&P sell-off likely. Check that video out right here. Fast forward to a minute 24 and watch from this point forward. I discuss in detail the three horsemen of the apocalypse, the kind of three major signals that always correspond with a significant recession kind of market top that precedes the usual 30 to 50% recession-led market crash. By the way, don't forget to subscribe to my second YouTube channel, Money Time Machine Legends. This is where all of the cool videos go. That means anything not related to technical analysis will go in here. If you want to subscribe straight up to it, just look up Money Time Machine Legends, or simply go to my current YouTube channel and click on this link. It'll take you straight to the second YouTube channel. If you like entertainment videos related to money as well as investing, you'll definitely want to subscribe to the second channel. So jumping back to the S&P 500 1-hour chart, again, we're kind of in this stage. Look for a consolidation near the top of the range pretty much early this week, very likely consolidation. Then look for the breakout for a rally that exceeds 565. S&P, again, likely makes a new high. NASDAQ 100 will likely exceed this prior high, but is not likely to exceed this prior high. In July, I'll be looking for two key price targets. The first is the prior high here, exceeding it slightly. That means around 490, 487. So between 487 and 490, high 480s, I would say. The second key price target is the gap fill at this level. That means just short of 500 for the NASDAQ. I expect the NASDAQ will likely top at this level somewhere between the second price target and the first price target, more likely than not, this gap fill level by the time we get that Fed rate cut later in September. September at 19th, I believe we'll get that Fed meeting 18th or 19th. So that'll be my price target for the NASDAQ. For the S&P 500, I think will very likely exceed the prior high and rally back to the top of the Bollinger Band here. That means, let's see, about 570 something into that Fed rate cut. That means a couple of weeks. Then we get final seasonal top that leads us into the September, second half of September, and throughout October, that kind of correction that comes in every election year. Take a look at the VIX. The VIX kind of now has this double top formation, slightly lower high on the second top. That is bullish. I actually talked about this in my last video. Let me add the S&P. Take a look here. The S&P 500 actually matched this prior low, but the VIX failed to make a higher high. That told us that bearishness, negativity, negative sentiment is actually exiting the market. The market now looks more optimistic. So the VIX, the volatility index, the fear index is declining, and we're now on the cusp of a second breakout in the S&P 500 to give us that seasonal topping process later in September. The way I am trading this is I did in fact wait for this pullback. By the way, this was drawn from the last video. I did not edit this in any way. This was drawn from the last video. I said the market will likely open higher, gap up, and then look for a pullback, buy it on an equal or slightly higher low. We did get an equal low for the S&P and a slightly higher low for the NASDAQ 100. I did enter a long position in the NASDAQ. If you're interested in following all of my live market analysis and all of my trades and investments in real time, check out the Money Time Machine Patreon page, where you'll get access to our Discord trading community where I share all of my analysis and trading activity. I did enter a long position in the NASDAQ 100 through an option. So I am now long the NASDAQ as I see this rotation continuing back into risk on asset cyclicals and technology. If we simply rally back to this prior high, the positions should actually yield about a 30% plus profit, even though measured from my entry to that level is about 2.5%. And if I see signs of a top or a failure at this level of resistance, I'll likely take profit. Otherwise, I may continue to hold all the way to this gap fill level at which this position should return in excess of 70 to 80% in profit. So if you're looking to get an inside look into my trading activity and all of my real-time daily stock market analysis, trade setups, weekly expected moves, all of that good stuff, check out the Money Time Machine Patreon page. It's also the best possible way to support the channel. So I thank you very much if you choose to do that. Now let's take a look at the Russell 2000, the small caps. The small caps are now forming this cupping formation. This does look like a bull flag. We tend to get breakout consolidation. Now expect another breakout in the small caps. The small caps love rate cuts, low rates, fuel small cap rallies. We've seen stocks that I've been watching for ages and that I've actually been invested in and recommending to all of my friends and family. Stocks like PayPal finally breaking out and making higher lows and higher highs and breaking above key levels of resistance. We've seen this all across the board. All kinds of stocks that have been suppressed due to high interest rates will now get to really spread their wings and rally as those rate cuts roll in before that kind of recession, slowdown in the economy hits the market and we get that top and then we get that recession-led sell-off. Take a look at the XLY relative to XLP. That means consumer discretionary relative to consumer staples. That means bullish divided by bearish sectors. We are now forming this bull flag that is about to break out. Look at this successive higher lows and higher highs as of Friday. I still have an expectation of this ratio chart to rally back to this prior resistance level. That means expect bullish sectors to outperform defensive sectors by at least 3% going into this week and next week. Also, just a side note, shortened trading weeks tend to be more bullish than regular weeks. That also gives us another boost this week. Another key chart that I follow is high yield bonds. Up top is the smart money. Down below is the S&P 500 / dumb money, what we call dumb money. And if you take a look here, high yield bonds, the smart money has exceeded these prior highs. The S&P 500 hasn't done so yet. Usually high yield bonds or smart money lead the market. And so now I am expecting a rally to exceed the prior highs in the S&P 500 before we get that seasonal top later in the month. S&P 500 relative to gold, we had this breakout, then consolidation. We are now breaking out again. This is again a risk barometer. You look at S&P 500 performance relative to gold because that tells you if the market is being bearish, defensive, or bullish, offensive, taking risk. And now we're seeing risk taking back on the table. That means S&P, NASDAQ especially will lead the market relative to consumer staples, utilities, as well as other defensive assets like bonds and gold. If you also take a look at the CPC put to call ratio, we have this double top formation, double top on the PPO, and we rejected again. We're now moving back down. We had a bullish buy signal. Let's take a look back here in August 16th. After that bullish buy signal, we had a consolidation. Now we're going to get that follow through and continuation to the upside as CPC, the put to call ratio, declines and as greed flows back into the market. This is the Fear and Greed Index by CNN, and we're now at 63. We're back into greed. We'll likely see a top as soon as we hit extreme greed. We take a look at the prior several months since really April. We haven't exceeded 62. We're now at 63. This is the first time we've exceeded that level in several months. TLT relative to SPY, one of the three horsemen of the apocalypse that I discussed, completely failed to break and close above the 10-month moving average. This means the market hasn't topped yet in terms of that major recession kind of topping process. Not there yet. You want to see the TLT close above the 10-month moving average on the monthly chart relative to the S&P 500. That usually triggers the major sell signal and calls the final top, as it did back here in November of 2007, called the top perfectly. And then we had that 50% sell off led by that deep recession. So far, we're nowhere close. We're not there yet. So it's not time yet to go heavy short, heavy defensive, deploy that recession playbook. It's not time just yet. When it's the right time, I'll update you all, obviously, because personally, I'm still buying the dips and selling the rips. So I'm still trading to the upside. I haven't yet rotated into a short downtrend kind of strategy because we're not there yet. The conditions are still bullish, even though we're getting closer and closer to the end. We're not at the end just yet. Tuesday, tomorrow morning, we'll get the manufacturing PMI. Wednesday, we'll get the JOLTS job openings. This is going to be a market moving event. However, the ADP employment change is going to be an even bigger event. And then the unemployment data, even bigger and bigger. You want to see unemployment at least flatten at 4.3 or even pull back slightly to 4.2. That will be bullish. We get another reading that is in excess of 4.3% that may cause the Fed to actually cut rates by more than expected. The market expects a 25 basis point cut this September. And if the unemployment data suggests that the jobs market is slowing down faster than expected, then expect the Fed to cut by more than that. Expect the Fed to cut more aggressively to save the jobs market, because once the jobs market really starts to drop off, that's when you get that real recession. When folks unfortunately start losing their jobs, that's when you get that recession. In summary, short term, the market is breaking out. Expect a rally in excess of the previous highs for the S&P 500. That means we exceed 565, likely top around the mid 570s later this month. For the NASDAQ 100, expect a rally to around 497, somewhere in there, maybe 500 by the end of the month, around the 20th, 19th of September, something like that. Then we get that seasonal top in September, boom, and then we get that seasonal correction leading into the election in early November. That always happens in election years. After that, I expect the final rally in the market before we get that recession-led topping process and crash. So topping process likely at the end of this year, maybe early next year, and then a recession kind of bear market that lasts maybe a year in 2025 and a final market bottom either in late 2025 or early 2026. This is my baseline expectation based on all of the charts, all of the data, all of the economic developments in unemployment data, the SOM rule, bonds relative to the S&P. All these key metrics point to a market topping process likely happening by early next year. That's all I have for you today, legends. Thank you so much for watching. Check out my second YouTube channel. Please subscribe to it. Smash the like button on this video on your way out, and I'll catch you in the next one. Bye-bye.
Oh, wow.